All right, welcome back, everybody. In this module, Module 4, we're going to be we're going to continue our conversation about debt, and we're going to talk specifically about using hard money to fund your fix and flip transactions. So let's dive in. Just like with every module that we've done so far, I've got to give you a disclosure. At the beginning here, I am not a licensed attorney, accountant, financial advisor, broker, or agent of any kind. So I'm just a student. I'm just like you guys. I have developed and found some strategies and some systems that work incredibly, and I've been able to be very successful in real estate investing using these systems that I am now sharing with you. So let's begin. Now, hard money. Let's talk about some definitions. Some of the main things I want you to understand about hard money is there are some loans out there that are what are called recourse loans and others that are non-recourse loans. So let's define each of those terms because we're going to talk about them later on in this course. A recourse loan is a loan in which the borrower is personally liable for the debt in the event that the collateral pledged to secure the loan is inadequate to repay the defaulted loan. So that means if you end up not being able to sell the property and you go past the amount of time that they let you have their money for, they can choose to not only collect the collateral, which means that they foreclose on the property and now it's theirs, but they can also choose to go after personal assets to cover the difference. So they can go after your cars, your house, your savings account, your retirement money, your insurance. A recourse loan really opens you up. This is where you have to personally guarantee the loan that you're using to secure your hard money. Now, obviously, that's not ideal. If you can find non-recourse loans, that's the best way to do it. And keep in mind, later on in this course, in a future module, we're going to be talking about how to fund your deals using other people's retirement accounts or even using your own retirement account. So in a lot of cases, the laws around that require you to have a non-recourse loan. So let's talk about what a non-recourse loan is. A non-recourse loan is if the borrower defaults, the lender can seize the collateral, which is the property in this case, but cannot seek out the borrower for any further compensation, even if the collateral does not cover the full value of the defaulted amount. This is where the borrower does not have personal liability or have to personally guarantee the loan. So obviously this is more desirable because the only thing that they're going to get if for any reason you default on that loan is the property, the subject property that they lent the money on. But your personal assets remain safe. So anytime you can go after a non-recourse loan versus a recourse loan, that's what you want to do. Now keep in mind, most traditional mortgages, which by the way are not, I don't necessarily recommend that. It's just way too much red tape, way too much work, and most traditional mortgages are recourse loans. So try to find, if you're going to be using hard money, try to find those hard money lenders that offer non-recourse loans. Now, let's talk about some of the vernacular. Let's talk about some of the terms. If you're going to start playing in this field, you've got to be able to speak the lingo, right? So let's talk about that lingo. You're going to hear terms like loan to value, or sometimes that's abbreviated to LTV. What that means is the amount of money that they will lend based on a percentage of the value of the property. Now, some hard money lenders will go off of the purchase price, and some hard money lenders will go off of the after repair value. So make sure you understand when they're talking about loan to value, make sure you understand whether they're talking about the purchase price or the after repair value, which is the projected value after it's all fixed up and you're ready to sell it. So typically, hard money lenders aren't going to lend you 100% of what you need. Usually it's 75 to 85% of whatever it is that they've defined their loan to value as. So 75 to 85% of the purchase price and or 75 to 85% of the after repair value. And we're going to talk about safe ways to calculate where you should keep your loan to value. Just because they offer 85% doesn't always necessarily mean that you should go all the way up to 85%. So, we'll talk about that in future modules. Points. That is a term, as you work with hard money lender, you're going to hear that term thrown around a lot. So points, think of it as like closing costs. Even a traditional mortgage that that you go and get from a bank are going to have points associated with them. They just refer to them in different terms. They refer to them as closing costs or origination fees or whatever the case might be. There's a lot of terms for it, but points is how a hard money lender refers to that fee. And 1 point is equal to 1% of the loan, regardless of the amount of time. So when we're talking about interest is related to time. Usually when you're quoted an interest rate, that's annual, right? If it's 8% interest, that's 8% annual. So you know that, if you go up to a year, you'll pay 8%, but if it's a half a year, if it's 6 months, you'll pay 4%, right? So points are that percent of the loan that you pay regardless of how long you have it for. And a lot of times those are due up front. You pay at the front end when you actually get the loan. Sometimes you can pay, some hard money lenders allow you to pay in the back end after you sell the property and pay back the loan. So keep in mind that points are different from interest, and you'll need to calculate that into your cost. We have included a calculator for you to go out and do quick analysis on. It's your quick analysis short-term calculator that runs the numbers for fix and flips. It has a spot in there for you to be able to account for those points that may be applicable as you work with hard money lenders. Now, interest, typically 8 to 15% is what I've seen. If you get much higher than that, there's probably a better deal out there, so keep shopping. But it's usually annualized. It's probably worth verifying that they're calculating that annually. But usually that's what people are talking about. Sometimes there's monthly payments. Sometimes with hard money lenders, you have to make monthly installments, and a lot of times that'll just be the interest that was accrued over the course of the month. So there are other money lenders out there. There's a lot of them out there that don't make you make monthly payments. They just collect the interest and the principal and the points once you sell the property and pay back the loan. So, based on what your goals are, decide where you want to be there. I usually like to look for the hard money lenders that don't require me to pay anything until the property's sold. So that's going to vary based on your goals. Just keep that in mind. Time to close. So this is the amount of time that the lender needs between your initial contact with them on a specific property and the closing date. So hard money lenders, you've got to allow them some time to get a contract together, to get their loan documents all put together. In some cases, they don't have the money just sitting in an account. They're pulling it from different sources. So you got to give them that time to get going. And different hard money lenders have different time to close parameters. So make sure that as you're having a conversation with your hard money lender, that you understand what their time to close is. Some can close in 24 hours. Some ask you for a week. So, and it could be more, it could be less. So just make sure that you are aware in that relationship of what their time to close is, and be respectful of that. Don't, every now and then there's exceptions, but don't ask them to cut that time in half on every transaction, because that will strain the relationship. Closing fees. So these are the quote unquote hidden fees, right? These are the things that pop up when you're going to sign the documents that you're like, oh, I didn't realize I was going to have to pay $500 for a doc prep fee, and etc. So make sure that you ask these questions before you initiate a loan with any hard money lender. What are your closing fees? Doc prep, recording, all of those things, so that you're not surprised by them when they're charged. Your term. So you're going to hear the word term used a lot in reference to loans. Your term is just the duration of the loan. This is the amount of time that the hard money lender will allow you to have their money. So usually that's anywhere from 3 to 9 months I've seen on average. I rarely have seen any loans that the term is lower or shorter than 3 months. I have seen a lot of loans where the term is 12 months, but usually it's somewhere in that sweet spot between 3 and 9 months, something like 6 months. Extension fees. This is a fee paid to extend the term. Typically, they just charge you more points, 1 or 2 more points. And for hard money lenders that don't actually collect those points until the back end, a lot of times those extension fees they'll push off until you sell the property as well. Sometimes you need to do this, right? If you got a 6-month term and for some reason you got delayed, whether that was for permits or because you had to switch contractors or whatever the case might be, it happens sometimes. So make sure you understand if you need to extend that loan, the term of that loan, if they even offer that as an option, and B, what those extension fees will be if you do need to extend that. You should understand that before you're in the loan. So make sure you ask those questions. And then a prepayment penalty. I haven't seen this very often, but I do know that they exist. Some lenders don't like you to pay off the loan really quick. They want you to have that money for a little bit of time because that's their business model. That's how they make money, is by lending it to you. So they want you to have that money for a minimum amount of time before you pay it off. And if you do pay it off early, they're going to charge you a prepayment penalty. So the average I've seen for lenders that do have a prepayment penalty is usually about 3 months. It can go longer than that. It can be shorter than that. And a lot of hard money lenders don't even have a prepayment penalty. But make sure you understand as you build these relationships what the prepayment penalty is, if it even exists, with your hard money lender. So where do we find hard money lenders? Well, they're easy to find. They're a dime a dozen. Pull up your search engine and go out and just type in hard money lender and then your state, right? Or hard money lender and then your city. And you'll probably have a handful of them, a couple pages worth pop up. Don't just go with the first one. Make sure that you interview a handful of them and that you make the best decision for you based on the data that you collect from the different hard money lenders. And then once you've made that decision, it's a good idea to establish a long-term relationship. The best way to establish a long-term relationship in business is to just keep giving them business, right? So, I have a really good relationship with a hard money lender, actually a few hard money lenders here locally. And the reason my relationship is so good with them is not only because I use them frequently, but also because I refer other investors to them. Don't fall into the trap of thinking that, you need to be the only customer of this hard money lender. That's a very scarcity mindset, and that's the kind of thing that ends up hurting you in the long run when it comes to real estate investing. Have an abundance mindset. If you've got a friend that's also a real estate investor, share resources with them. There's no reason not to, right? Let them go out and be successful as well. There's plenty of deals. There's plenty of money, and you don't need to have a competitive or a scarcity mindset when it comes to real estate investing. Those types of relationships will pay off dividends in the long run, especially if you're providing referrals to these types of professionals. You can also find hard money lenders on Craigslist. Sometimes you need a referral and you reach out to other investors and you ask for that referral. Hopefully they have an abundance mindset and will share it with you. A lot of agents have relationships with hard money lenders, and I'm referring to real estate agents or realtors. Sometimes mortgage lenders will have referrals for hard money lenders. I would say your best bet's probably just good old internet, right? Go out and do a search and just start interviewing your hard money lenders and figure out what's going to be the best fit for you. Now, let's talk about some questions to ask your lender. Okay, so when I say go out and interview your hard money lender, here are some questions to ask, and you may have more questions to add to this list, but this will at least get you started. Do you lend in my state? How quickly can you fund? Can you provide a proof of funds? Now let's talk about that for a second. Proof of funds. Sometimes when you make offers, especially if they're cash offers, people want to know, and in some states you can actually make a cash offer if you're going to use hard money because it's semi-institutionalized in a lot of cases. It's not like you're going out and getting a mortgage. But they want that proof of funds to know if they're going to accept your offer that you can perform on what you're promising. There are a lot of uneducated investors out there who go and waste sellers' time, and that's why asking for a proof of funds has become common practice in the offer process. For more information on that, by the way, check out our Finding Off-Market Deals class. There's a lot of really good information on how to go out and make offers. But providing a proof of funds may be something that the seller asks for, and they're well within their rights to do that. So make sure that your hard money lender has that available. Now, what a proof of funds is simply, it can be something as simple as a letter from your hard money lender that just says that you as the investor have a line of credit with that hard money lender for a specific amount. You'll want to make sure that that amount covers what you're offering. It may be, and sometimes sellers want a little more specific and a little more detailed proof that you have the funds available. So sometimes that may look like a screenshot of your bank account showing that you have the money in there, or a screenshot of the lender's bank account showing that they have the money in there. So, there may be a little bit of back and forth between the seller and the hard money lender as you're out, making offers on deals, but that's okay. That's normal. So be prepared for that. How many deals can you do at a time? Now, this is important to understand, because if you're going to scale your business to a certain point, you want to make sure that the people you're surrounding yourself with can scale with you. So asking the lender how many deals they can do at a time is an important question. What is your loan request process? So to make it easy, a lot of these hard money lenders have systematized the way that you request a loan, which sometimes is a form that you fill out online. Sometimes it's a piece of paper that you fill out and you can scan it or fax it back to them. But make sure that you understand that process just to make it easy on yourself and easy on them. Is your LTV based on purchase price or ARV? Remember, we talked about that a few slides ago. LTV stands for loan to value. So is your loan to value based on the purchase price of the property or on the after repair value of the property? Of course, ARV stands for after repair value. How many points do you charge? And are they front end or back end? What interest rate do you charge? What other fees do you charge? Are they front end or back end? Meaning, are they payable when the loan is initiated or when it's paid off after you sell the property? What is the term of the loan? In other words, like we talked about, how long am I allowed to have these funds? Do you charge an extension fee? If so, how much? Now, remember our example deal that we were referring to as 123 Main Street. This is the deal that we're kind of comparing all of these different funding models with. So if we take a look at this deal and we run the numbers, let's start calculating the costs. And remember that you have a calculator inside of the resources section of your education. Your quick analysis calculator is going to help you calculate all this stuff. But I want you to have a good understanding of how to do this longhand, because you're not always going to be in a situation where you can pull that up. So number one, identify the loan. For example, you have a $300,000 loan. Make sure you account for points. So if there's 2 points, you're going to take $300,000 and you're going to times it by 0.02. That calculates your 2 points, which is $6,000. Then calculate the interest. So if you've got a $300,000 loan, and let's say it's a 12% interest rate, so you're going to take $300,000 and times it by 0.12. That's $36,000 that you'll pay in annual interest. But that's only if it goes for a full year. So I usually like to divide that out and figure out exactly what I'm going to pay per day. 36,000 divided by 360, which, by the way, 360 days in the financial world is what they use as a calculation instead of 365 days. So keep that in mind. I think it's because of the leap year thing. Some years are 365, some years are 366. So for some random reason, the financial industry just decided to call a year 360 days. So your per diem is going to be $100 per day, or per diem. That's just the Latin term for per day. So at $100 per day in interest, you're going to calculate. I usually run my numbers at about 6 months, which is 180 days. At $100 per day, that's $18,000 in total interest. So now you take all that information and you do the math. That's step 4 here on the screen. So you take your 6,000 in points, you add it to the $18,000 that you project to pay in interest, the $500 in other fees that they charge. That comes to a total of $24,500 as your total costs of funds. Now, as you're running the numbers on your property, you're going to have a really good understanding of what your margin is going to be. So that's your margin is after you've calculated the cost of the property plus the construction, and you basically calculated in all of the costs, utilities, taxes, all of those things, except for your financing costs. That's going to be your margin. So all of the costs except for the financing costs are your margin. And in this case, if we have a $60,000 margin and we subtract our financing costs of $24,500, that gives us a $35,500 projected net profit. So now we can calculate, based off of that, our break even. How long can we go before we're making $0 on this deal? And the answer in this case is about 17 and a half months. You always want to know that number so that you know when you need to switch to one of your exit strategies, right? Now, let's take a look at this. One of the reasons that I've always shied away from using only debt to fund fix and flip transactions is because it limits the number of exit strategies that we can do. And this is a mistake that a lot of uneducated investors make, or partially educated investors make, right? We all know that a lot of people lost money in the decline in the economy in 2008. And I think a lot of reasons that the amateur investors lost a lot of money is because they structured the way that they were taught to use other people's money in public school and with their employee mindset, and that is borrow it, right? And when we borrow money, it's considered debt, and we owe that money back no matter what. If the market changes, it doesn't matter. You owe that money back plus interest and fees. So that creates an incredible risk. And partially educated investors. Well, let me pause for a second. I want to speak a little bit more to that. Let's talk about 2008 for a second, because I know that's a fear that a lot of aspiring real estate investors have. What happens if the market changes? Well, the key to protecting yourself against a market change is just simply making sure that you create an opportunity for exit strategies. The reason people lost money in 2008 is because they only had one exit strategy when they went into their respective deals. I want to sell this property for more money than I put into it, right? And when the economy's going up, that's easy to do. But if it changes while you hold the property, then you're kind of in a pickle. And we don't want to be in that situation. The nature of money. Money does not get destroyed. In 2008, there was, it wasn't like there were dump trucks driving around collecting as much cash as they could find, and then they took it into a field and dumped it into a pile and doused it with gasoline and lit it on fire. That's not what happened in 2008. The nature of money is that it transfers. So while there was a lot of uneducated investors that were, caught with their proverbial pants down in 2008 because they didn't create exit strategies for themselves, that money wasn't destroyed. It was just transferred into the pockets of the educated investors, right? So there were a lot of people that made money in 2008 because they were smart and they knew what to do in the case of a market change like we experienced. That's what I want you to become. I want you to become that smart investor. I want you to know what to do. You can make money in any market climate. You can make money on a deal even if you were planning on doing one thing with it and then the market changes and now you do another thing with it. You just have to know those strategies. The difference is knowledge, right? And so you're making the right decision by becoming educated investors. But let's take a look at what happens to this hard money guy as he's put through a scenario like I just talked about, okay? So the guy that goes out and gets hard money to fund his deal, you only need to borrow enough money to be able to purchase the property and to rehab it. So, that's $300,000 total based on our example. And so this investor goes out and pulls up Google and types in hard money lender, right? And up pops a list of hard money lenders. On average, you're going to see about 12% interest and a 6 month term. That's fairly average, I would say. Definitely can vary, but I'd say a decent benchmark there. So, should be fairly easy to execute this transaction if nothing happens. If we're on time with our rehab, if we're on budget with our rehab, and if nothing happens to the economy, everything should be able to go well. But you know what? As investors, we don't always have control over all those things, especially what's going on with the economy. So part of the research that I do when I'm deciding whether or not I want to take on one of these, any particular property as a fix and flip project is I'll go back historically and I will look at the historical value of the property over the last 10 to 15 years. So let's say, we go back 10 to 15 years and we see in 2008 this particular property dropped to 280,000. Well, that's going to be our low water mark. That's what we're going to have to prepare for, because we want to make sure that if something as bad as 2008 happens again, we're prepared. So in this case, the person who borrowed this hard money, they've got no options. They can't rent it out because their hard money lender only is going to let them have the money for 6 months. And, 2008 took longer than 6 months to recover from. And they can't sell it because they're upside down on what they owe. They're going to end up owing $20,000 worth of principal on what they borrowed, plus another $44,500 on fees. So they're at almost $65,000 check that they'd have to write if they sold this property. So that's not going to work. You can't take it down to the bank and refinance it because you're under collateralized. The value of your property is only $280,000 in this event. So no one's going to refinance out that $300,000. So you're kind of sunk. And this is exactly why people lost money in 2008, is because they didn't create exit strategies ahead of time. I'm going to talk to you in a later module about a strategy that I use called the debt equity blend, where I take a combination of debt and take on equity partners on each project to make sure that we protect ourselves and create those exit strategies. So this is one of the main reasons that I don't like only using debt to fund fix and flip properties, is because it creates an incredible amount of risk if things happen that are out of our control, right? So it's kind of like gambling, and I don't like gambling when it comes to investing. I prefer to be educated and keep my risk low. So let's talk about some of the pros and cons of using hard money. A lot of times, so let's start with the pros. A lot of times there's no income verification, which means that you don't have to necessarily qualify personally for the loan. They're just most of the time going to be looking at the property, not your personal financial situation. So it doesn't appear on any of your credit reports. So in most cases with hard money lenders, they're not going to report to your credit. They're not going to, unless it's a recourse loan, and you default on it, then there'll be a negative mark on your credit. But as long as you're in good standing, it should never show up on your credit report. Usually hard money lenders can fund within a few days, which is very convenient. And the lender understands that the property is not turnkey. So hard money lenders have a lot of experience working with fix and flippers. In fact, I would say that's their bread and butter. So when you're working with a hard money lender, they're understanding what your plans are going into it. And that creates a very positive relationship, just having that understanding, and it minimizes the need for excessive communication. Now let's talk about some of the cons. Like we talked about in the last module, debt is very expensive. It's not as expensive as hard money, but as you can see with with the amount of cost of funds that we calculated, $24,000 is a lot of interest to pay. And so in that respect, it's expensive, right? And the longer you go, the more expensive it's going to get, because it's indexed based on time. You still, in a lot of cases, you still need money, because most hard money lenders won't lend 100% of what you need. So you're either going to have to come up with your own money or get a second loan, which makes it even more risky. With debt, it's always higher risk for you and lower risk for them, because you're signing an agreement that says you'll pay it back no matter what. So it's always a higher risk for you and a lower risk for them. Sometimes there are monthly payments. Sometimes there's a prepayment penalty. And in most cases, they will only allow first position loans, which means, so let me explain this a little bit. So on the title, there are positions for lenders to file liens against your property. If you go get a mortgage on the house you live in, that first mortgage that you get is going to go in first position. That means they have first right to foreclose, right? If you go, after you get that mortgage, if you go get a HELOC or a home equity loan, usually that goes in second position. So it's behind, they have a lower priority when it comes to foreclosure on your house. So second position loans tend to be a little higher interest, and a lot of hard money lenders won't do second position loans. They'll only do first position. And the benefit to them, the reason they do that is because they want to be the first to decide whether or not your house is going to be foreclosed on, right? They don't want to have to get someone else's permission to foreclose on you. So a lot of times, it kind of rules out, it makes it really difficult to find that bridge money if you're not using another strategy like the debt equity blend. that we're going to talk about later. So that wraps up module number 4, talking about hard money as debt. Our next module, module number 5, we're going to be talking about using private money as debt and some of the pros and cons of doing that. So stay tuned for module 5. I will see you guys over there.